Okay, good morning, folks. My name is Peter Armitage. I run Anchor Capital, and this morning must be about the 20th version of Where Will the Money Be Made. Every quarter, we run through our view of prospective returns from asset classes, talk a little bit around the investment world, and give you our views on where money will be made. I think just to remind people that this is based on a comprehensive document that got sent out a week or two ago. So for those of you who don't have that, give your wealth manager or financial advisor who deals with us a shout, and we can get that through to you. It's obviously also available on our website. And we do that quarterly, and every day we send out a morning newsletter, which gives people some context of markets. Just a quick reminder from our perspective of who we are. Anchor is an 11-year-old wealth and asset management business. We've got a full range of investment options, both locally and globally. We've got about 400 staff across our group. We manage about 115 billion rand of client monies. About, depending on how you measure that, roughly half of that is sitting offshore. And I think one of the themes that consistently comes through on many of our webinars and conferences is to view yourself as a global citizen, diversify appropriately. I don't think we're in the scare camp from a South Africa point of view. We think there's still a lot of potential and opportunity here. But SA is less than 1% of the world. And the investment options and reality of where we sit in South Africa with very low economic growth always leads us to suggesting a well-diversified global portfolio. We've got a comprehensive investment team, 20 people feeding into our process, looking at local property bonds, equity, global private equity bonds, etc. So one thing you can rest assured of is anything you invest with Anchor is well-researched, and I couldn't be prouder of the investment team we've put together since we started this business. I think to start off with, the key message and the key slide that we're all going to refer back to in this presentation, and you'll hear four of us talk over the course of the next hour or bit, is the message that we're sending out where returns can be garnered. I think from a domestic point of view, we neutral on SA equities. Neutral doesn't mean, it means kind of neutral compared to everything else. We're expecting about a 12% return in rands over the course of the next 12 months. And that's in the context of a fairly muted return over the first half of this year. I think probably the biggest, kind of equal biggest driver in terms of domestic equities is China, and that's been slow to rebound. SA issues have seen bond yields kick out. So we're looking at a projected return of about 11% from SA bonds, which with inflation at 5.4 is a nice real return. Listed at property and cash coming in at around 8%. And obviously the big thing that's changed from a domestic and global perspective is interest earning instruments. And you can now earn, a core income fund is running at about 9.4% without any risk. Then the alternative space, which is something we've been developing, and Henry will talk a little bit more about a bit later. Some very nice steady returns in the kind of 10 to 14% range can be achieved. And we're increasingly putting some of that into client portfolios. From a rand point of view, Nolan will explain why we think the rand will be about 7% stronger over the course of the next 12 months. Flipping through into global, and it's fairly interesting, if you look down the middle there, we're talking about neutral across all asset classes, it's very seldom the picture looks like that. And that's a mixture of some very nice yields available. We can earn you 5.2% in the JP Morgan money market fund. So because rates have gone up so much globally, there's some very nice yields that can be earned without taking any risk. Nolan's got some very nice funds which capture the corporate credit market. And the equity market has been surprisingly strong this year. So we're still positive on equity markets, but given the very big return over the course of the first 6 months of this year, about a 16-17% return, we think there's every chance of a bit more of a muted return over the course of the next little while. But as Mike will explain, where the return has come from is very important to understand. It's really been an AI-driven market. And then again, alternatives offshore, we've got products and offerings in the kind of 8 to 15% dollar return category. Obviously, generally, the higher the return, the higher risk that you're taking. But there's some nice, because interest rates have gone up, and with what's happened with volatility, there's some very nice options available on the non-pure equity side. So this is really what one should be aiming to return over time: 6% on bonds, 8% on REITs, 10% on stocks, and then kind of between the 8 and 12 on the more alternative type products. So that's a very brief summary. I also just wanted to take a few minutes to discuss what we're experiencing and what most of our clients are experiencing in the SA market at the moment. And when I think about the average client meeting that we're having, the first 10 minutes is almost always occupied by a discussion around the anxieties for South Africans and the worrying stuff that's going on around us. And I thought, maybe just to give you some headline thoughts on that before we don't want to naively go straight into investment markets when there's things on people's minds, which certainly affect the future and how they view their future investment. And those center around the rand, Eskom, politics, water and infrastructure, Russia, the low economic growth, interest rates growth, etc. So maybe to separate those out. I think the key thing in the message we try to get across to people is a lot of these things are knowns, and there's room for anxiety on it. And we're certainly realists and not dreamers in terms of the future of South Africa and the challenges that we face and the way that we're approaching them. But you can separate that emotion and your investment portfolio. And, we particularly like the phrase which we often use, which is live in the sun and invest in the shade. South Africa is an incredible place to live with great people, great attitude and fortitude. We've been through many, many tough times in the history of the country. It's a country full of opportunity, but that doesn't mean you need to align your economic and investment outcome completely with South Africa. So, diversifying your portfolio globally and having a plan, and I think that's one of the key messages to get across, work with your financial advisor, work with us to have a plan, so that no matter what scenario materializes in South Africa, and the investment outcome for you will be a good one. For those who had enough money offshore, this year, the rand weakening up to 20 or so was not an anxious time from an investment point of view, but you need to take the moves. And, I think particularly now, the rand's come back from close to 20 to the dollar to close to 18. And, I think people get lazy again and they go, well, it's not too bad. I think now's a pretty good time to continue to implement the plan and to invest and position yourself as a global citizen. We've also traveled quite a bit around the world over the course of the last 6 months from an investment and other perspective. And just to make the point that it's not all rosy out there. I've got some guys in the US who's saying if Trump comes back in, they're going to live in the UK. We were in the UK last week, and people there are really screaming about the cost of living and being squeezed. If you haven't fixed your mortgage bond in the US, your mortgage payment's gone up 3 or 4 times. Mauritius has been a haven for some people. We've recently seen some people coming back. And, going back into the beginning of last year, Europe, with war on the borders, lots of threats there. So on balance, SA ain't such a bad place to be. I think you're seeing lots of strikes in France, which is proving quite worrying, where some extremist elements of society are acting quite violently. In Spain, you're seeing the far right getting up to 30% of the vote, and lots of things happening there. So let's quickly go through the things to worry about. Number one is the rand. I think, kind of the basic advice is take it out of the worry zone. Accept the fact that the rand is probably going to weaken by about 5% per annum. But you can position yourself from an investment point of view to benefit from that as opposed to lose from it. But Nolan will talk a little bit more about that in his session. Eskom and load shedding. which to me is certainly the most damaging impact on consumer sentiment and positivity in South Africa. I think the reality is we were with load shedding for some time. There was a bit of positivity, if you could look back a few weeks ago, where kind of the lights stayed on and everybody was a little bit mystified. There will be periods like that. But I think the good news is there's a surplus coming. Lots of stuff that has been broken down is getting fixed and coming back on stream. And the private sector, put in context, the SA has got capacity of about 45 gigawatts. It's producing between 25 and 30, and demand at the moment is sitting around 30 to 32. Within that context, there's about 10 to 15 gigawatts of private power that's coming on over the course of the next 2 years. And you see some headlines with multiples of that over the course of the next 5 to 10 years. So a lot of the positive things in South Africa are where the private sector is being allowed the opportunity to replace what the government has been inefficient at doing. And we're hoping that Transnet and the ports will be the same sort of issue. So there is some pressure, but there's a lot being done behind the scenes. When we talk to the banks, they're talking about R1 trillion of financing of renewable energy in South Africa over the next 3 or 4 years, which would equate to that 10 to 15 gigawatts that I talked about. Water and other infrastructure, I think the decay of infrastructure in cities and the like is a massive negative issue in SA. I think, again, we want to be realists. I don't think South Africa is going to be good at that. There will be issues. But I think, the positive side of it is government is allowing the private sector to get involved. They're granting concessions on rail lines and the like. There's been a lot more moves towards working with business to try and solve solutions. So hopefully they've learned some lessons from the electricity mess that we find ourselves in. From a politics point of view and corruption, Zondo Commission, etc., I think things haven't turned out as positively as we might have hoped, but the direction is the right one. I read a quote the other day, there are 2 possible coalition governments. They could both involve awkward compromises and potential instability. The prospects worry many within the country and outside it. So that quote, interestingly enough, is not about South Africa. It's something that I was reading about Spain last night. So coalition governments and the way that those pan out are global issues, and a lot of countries around the world have to deal with that. I think it's not in dispute that the ANC is in decline from a percentage of the vote perspective. I think there's a lot of good people in South Africa who are impatient with the way that things have materialized and are progressing. So I think we're at quite a low ebb. That's the good news. I mean, if that's the only good news, it's not fantastic news, but I think there is room for some more action. I think everybody is keen and focused on a more action-orientated economy. And I guess one of the questions is, whether Ramaphosa carries on as president post the 24 elections. NHI is an issue on people's screens. I don't think practically that's going to impact any of your lives over the course of the next 3 to 5 years. We continue to watch it, but it's really at the primary healthcare end that we're going to see some changes. Russia is an issue that's really bothered people, and I seen our kind of assumed alliance with them. I think Putin not coming to SA over the course of the next month with the BRICS conference is a positive, and it's shown that we are prepared to act and not totally shoot ourselves in the foot from a global perspective. I think the ANC is simply not dumping an old friend. Russia was a great friend in the apartheid years and helped people, and they're showing some loyalty there, but one's got to do so on a measured basis. Then we get to the economy, interest rates and growth. I think, there's 2 things to remember: the global backdrop and then the local circumstances. So the global backdrop is 90 to 100% of the way through the hiking cycle. Rates have gone effectively from 0 to 5% in the States. They might go up a little bit more, but we're going to reach the top of that cycle some stage in the next 3 to 9 months. I think if you look back to the beginning of the year, a lot of people had expected rates to start declining by now, but it's going to take a bit longer. But US inflation's got down to 3%. So a lot of the negative pressure is nearing an end. That's also flowed through into SA, where we've simply had to keep on increasing interest rates to make sure that the yield that you can get on money that you invest in rands is attractive enough. It's been the key driver. It hasn't really been, it's been much more about that than actually about inflation. So that cycle will come to an end. We'll probably see interest rate decreases next year in SA. There might still be a little bit more to go on the increase perspective. So that from a pure economic cycle point of view, we're nearing the top of it, which is the good news, and obviously feeling a lot of that pressure. Our inflation's come down to 5.4%, and Nolan will talk a little bit more about that. Structurally, until electricity is sorted out, we're going to remain under a lot of pressure. So we've kept out of a lot of the kind of SA Inc. type shares. On the SA market, there's a lot you can invest in, which is not subject to the issues that I've talked about. But once we get to, private sector trillion rand investment in electricity and being allowed to take over some of the functions of infrastructure, et cetera, in SA, I think we could have quite a nice cyclical upturn if one looks at 12 to 18 months. So that's a summary of, kind of the issues on people's minds. I think we are at a low ebb, and good news is at a premium. But scenarios differ. And what we like to work with people on is to say, let's look at the different ways things can pan out. And what you can do is make sure from an investment point of view that no matter what scenario, that you'll be all right, and in fact can benefit from the scenarios that are on the table. So I guess that's the message we wanted to start with. We're now going to get into some more technical and market-orientated perspectives, and we're going to start off with Nolan Wapenaar. Nolan is our co-chief investment officer at Anchor. He's been with us for almost since the beginning. He's grown a very strong fixed income business and provides counsel across our entire investment universe. So Nolan's going to tell us about bonds and fixed income in a world where they've become a lot more attractive than a few years ago. So over to you, Nolan.
Thanks very much, Peter. Hello, everybody. I'm delighted to be presenting to you again, and thank you very much for joining us this morning. I'm going to be speaking to you about fixed income, a little bit on the currency for the next 10 to 15 minutes, and then hand back to Peter. In that context, what I want to do today is jump in and start talking about global income for a change, sort of shake it up from a normal sequence. And in the context of global income, I've got a chart here which shows you the real yield over time. Let's dig into what that means. So Peter mentioned earlier that US money market funds are yielding about 5% right now, and that US inflation is about 3%. The real yield is basically how much interest income is greater than inflation. So if you're earning 5% interest income, your inflation is 3%, you're earning 2% more than inflation on money market investments right now. You've got a real yield of 2%. So what I've got here is a chart of the real yield over time. It's over the last decade. And you can see how the real yield for much of the last decade was negative. And then coming out of COVID, as inflation spiked and the Federal Reserve was slow to act, you can actually see how the real yield got very, very negative. And right now it's hovering around the 2% level, as I've just explained. Looking at that, there are two very, very important sort of consequences that I want to talk about. And the first one is that if I cast my mind back to 2021, when inflation was going sky high, what were people and economists talking about? Well, you had the majority of economists talking about transitory inflation, and yes, that didn't quite work out to be transitory. But the sort of minority view was that the US Fed was going to have to hike interest rates, and they were going to have to hike interest rates to the point where inflation starts coming down. Typically, that is where you have a positive real yield. So the good news from this chart is that we do have that positive real yield, that interest rates are actually high enough right now, firstly, to act as a bit of a drag on the economy, to be restrictive, and secondly, for inflation to start coming down. So that in of itself is enough to give us confidence that we are 90% of the way through the hiking cycle. I say 90% because I'm not 100% or I'm not convinced that we're going to be able to raise the sort of mission accomplished banner on inflation. It is still too high at 3%. It still needs to drift lower. And I think the Federal Reserve would probably like to see one, potentially two more interest rate hikes before we get to the end of the hiking cycle. But the heavy lifting is done. A lot of the pain is done. The second point I want to make is that if you look at this, what it really is saying to you is that investments in cash, investments in fixed income are today more attractive than they have been at any time over the last decade. And that's filtering into our investment views and our investment process. So from that perspective, what I've got here is a sort of table that I pulled off Bloomberg showing you what interest yields are available today. And read this in the context of inflation being at 3%. And the way to read it is I'm looking at government bonds in the USA, and the 3-month bond is at the moment yielding 5.32%. So you lock your money up for 3 months, you earn 5.3% on that. If you want to lock your money up for longer periods, the market is saying at some point the Reserve Bank or central bank is going to cut interest rates, so you earn a little bit less if you lock in for 2 years, 5 years, even 10 years. But the point is, across the full length of those yields, you're actually earning attractive real yields, which is something that we need to take into account in our thinking, particularly as we get towards the end of the hiking cycle. So from that perspective, what are we saying about global fixed income? Cash is interesting. Cash investments, money market investments, 4.5% to 5%, 5.2% Peter was talking about, very, very attractive. Definitely worth thinking about, definitely should be a part of your portfolio for the first time in a long time. There are a few hikes left, maybe, but it's time to start thinking about interest rate cuts. If we can lock in these yields for longer periods of time, it actually serves our investment purpose a lot better than just sitting and riding the yield curve down next year as we get into the cutting cycle. So from that perspective, Anchor likes bonds that are maturing in the sort of 4 to 10 year range, because it's nice to lock in yield for a slightly longer period. And what is our preferred investment right now in the fixed income space? It's actually the Global High Yield Fund. It's yielding about 6% for investors, and that's in bonds that all mature through to 2026. So you're locking it in for about 3 years, which is actually a lovely place to be right now. Turning domestically and thinking domestically, Peter's already spoken a lot about the risk factors domestically, and I'm probably going to just add a little bit of flesh onto the bones. But the greatest risk factor that we need to talk about has been rising interest rates. For the last 2 years, US interest rates have just marched steadily upwards. And as they've done this, it's like a headwind for investments. And you felt this in fixed income, you felt this in equities. Pretty much any of your investment asset classes have been fighting this headwind of a higher interest rate environment. I've just said that this higher interest rate environment is probably going to come to an end. And by the end of the next 6 months, I think we're at peak rates and yields track sideways. The headwind stops. You stop having to fight, against the sort of currents in the jet stream. At that point in time, investing actually becomes a lot more attractive, a lot easier. Suddenly you're going with the flow again. And I think that is fantastic. And it's great for South Africa as well. I would suggest that, of the rising rates that we've seen, probably 60% of it is tied to the fact that US has been hiking rates, and therefore we've needed to follow. As the US gets into a cutting cycle, I think there's massive opportunities. There's a much improved outlook for all asset classes, particularly fixed income domestically. Second point I'd make is one that Peter touched on, is Eskom. And Eskom is certainly something that comes up in every investment discussion. 2 months ago, people were talking about the risks of stage 8 load shedding in South Africa. It probably wasn't as bad as we feared, and Peter mentioned that. But the point is also that, we're going to build a shortened chimney at Kusile. Yes, we're going to pollute a bit of sulfur into the air. Not great. But the reality is that with a bit of delayed work on Koeberg means that where we're currently talking about stages 4 and 6, by year end, we're probably talking about stages 1 and 2. And that in of itself actually just has a bit of a feel-good factor, and obviously it's quite productive. In terms of getting load shedding sort of all the way removed, certainly not a 2023 discussion, potentially further into the future, but the trend is that with improved maintenance from Eskom coupled with private sector contributions, load shedding becomes significantly reduced and slowly peters out over the next 2 years, shall we say. Improved outlook. The next point is Vladimir Putin, and this actually resolved itself between me drawing up the presentation and me presenting it. So obviously, Putin has been told not to come to South Africa. I think that that's a good outcome. I think that makes the political environment a lot easier for us. But the point I'd also make is that, you know, the longer term sort of message of, you know, you've had a friend in Russia, and that is important, but you can't bite the hand that feeds you today, is one that has also obviously landed. And by that, I mean that 2% of South Africa's trade is with Russia. And if I take China out of it, something like about 40 to 50% of our trade is with the Western countries, if I look at Europe and the US. From that perspective, we've got to actually be friends with our current trading partners as well. And that message is very clearly something that's landed as well. So I'm actually quite positive about that, and I think that I have an improved outlook on that. So where we then get to is, well, the big issue with Putin was all about trade. And in terms of looking at South Africa's trade, the first thing that always comes up is the American Growth and Opportunities Act, the AGOA Act. And will South Africa be removed from that act? Honestly, South Africa was probably hanging on to inclusion of those benefits by a sort of fingernail anyway. I think it is going to be a very difficult challenge for us to, you know, maintain those benefits longer term. So from that perspective, I'm actually still worried that, you know, when they get around to looking at this, South Africa probably finds its benefits either curtailed or removed completely. And then coupled with trade is the fact that Transnet is very clearly in a problematic situation, and there are risks that it does an Eskom 2.0 in terms of just, you know, failing to deliver what we need. So from that perspective, I take a little bit of comfort from having seen the sort of ports contract for Durban to, you know, bring in the private sector. We need to see more of that. But right now, in our minds, I think as, you know, as these risk factors become resolved, the next one that we're going to be talking about is trade. And I think that that's going to be with us for the rest of the year, and it's going to create wobbles in the market. And then finally, as we head into next year, Peter mentioned that we've got an election coming up. And it's very plausible that the ANC is going to need a partner to govern the country, and significant uncertainty and, you know, concern about who they choose as a marriage partner. So from that perspective, you know, the risk factors we were all worried about probably going to work out okay, but we've got to keep an eye on some new things on the horizon that are uncertain. Overall, though, if I look at the sort of balance of these, I think that things have improved. I think that we are in a better position than we were 3 months ago. I think the outlook is better than it was 3 months ago. So from that perspective, I think that this combination of factors becomes investment positive, and it becomes fixed income positive. So what can you earn on fixed income investments? And I've tried a new graph here because I was getting a little bit bored of the old one I was using. But the way to look at this graph, and I'm going to look at the bottom all the way on the right, is the ZAR 2048. It's the 2048 maturity. So what it's saying is if you lend money to our government through to 2028 or 2048, what you will earn as a yield is what we're plotting here. And that whisker, that line top to bottom, shows you what the available yields were as the yields change every day over the last year. And you could see it, you know, you could have earned anywhere from about 10.5% to 12.5% over the last year, depending on when you lent money to the government. And 60% of the time, the yield was actually within that sort of block. And then the other 40% of the time, it was above that block. The little dot right at the top there is what you can earn today. And the point I'm making is that at just over 12% yields for much of the graph, it's cheaper than it's been for a very long time. It's cheaper than its history. And actually, that's in an environment where we think that the factors are gradually turning positive. So that becomes quite interesting for fixed income, because what we're really saying is you can earn 12%. So turn that into something that's easier to talk about. You can earn effectively 1% per month on fixed income investments, depending on what bonds you look at. And as these factors turn in your favor, as we get to the peak of the hiking cycle and gradually start thinking about a cutting cycle, you're actually potentially talking capital gains. % a month with potential capital gains in a year or so's time. Very, very interesting. So from that perspective, we actually think South African fixed income is definitely worth looking at within your portfolios as well. So what are we saying on domestic fixed income? Cash-like products are very interesting. Peter mentioned our core income fund yielding 9.4%. Compare that to inflation of 5.4%, inflation plus 4%, very little risk, very, very nice. And then the global environment and even the domestic environment is actually becoming increasingly positive over time. Definitely worth looking at bonds in our portfolios. Just to wrap it all up, though, I've been asked to talk about the Rand. And I'm keeping the chart that I used this time around, and that's looking at the Rand using a purchasing power parity model. And what we do is we basically say that over long periods of time, the Rand will depreciate against the dollar at about the inflation differential. South African inflation is 5.4%, US inflation is 3%, 5.4 minus 3 says the model is now talking about a 2.5% depreciation of the Rand over the next year. And as you can see on this chart, you've got my sort of Rand fair value, which is that wider brown bar, and then you've got where the Rand was, and it basically never listens to the PPP model. But it still gives us a sense of the fair value of the Rand. And 2 points I want to make here. First point is if you look along to the right of the model, the US inflation has been very high and that differential was negligible. Suddenly that differential is there, and that differential is going to widen out even further over the next year. So the fair value of the Rand is almost at the end, there's like a kink, it turns upwards again. And that means that the propensity for the Rand to depreciate is increasing. It means that, Peter was talking about the Rand's going to depreciate by 4 to 5% per annum. We're getting back to those sorts of environments where that's going to take place. The second point I'd make is, yes, the Rand screens very cheap against fair value right now. And there have been two major reasons for this. The first has been the US hiking cycle. Typically in a hiking cycle, the Rand weakens. We've seen that. I think some of that will come back. And the other aspect of it has been South Africa's own goals. I've talked about a variety of those. We're not through the own goals. There are going to be challenges for the Rand going forward. If we pull this all together, how are we thinking about the Rand? The Rand's at about 18 right now. We've suggested that the Rand could strengthen to about 1750 by year end, in 1 year's time, and probably about 1680 in 2 years' time. So it's a very gentle recovery from where it's been, primarily because structurally the risk factors have played out in SA. Looking at that, we do think that there is a possibility of stronger Rand, but it's not meaningfully screaming stronger. So we are comfortable to say if you are looking to invest abroad, phase your money abroad. This is as good a time as any to take some money out, except you're never going to get the strongest Rand, you're never going to get the weakest Rand, but you do need to make a move. And it's just, gradually I would start moving money out from this level. With that, I'm going to end here and hand back to Peter, and I'll be back for Q&A. Thank you.
Thanks, Nolan. So a pretty interesting equation and low risk returns that can be earned in the fixed income market, both locally and globally, which then takes us over to equities. I think we have a strong equity DNA in our business. We get very excited about shares and the ability to create wealth by backing the right company and the right leader at the right point in time. So Mike Gresty, who runs our local and global equity process, will talk to us now. Mike's been with Anchor, I'm not sure exactly, probably 5 or 6 years. He's played a massive role in building up our portfolios with the rest of our equity team. Mark's got an excellent and very impressive track record in the market, having run research teams at Deutsche Bank and Citi and the like. And he's going to talk us through global and local equity markets.
Great. Thank you very much, Pete, and good morning to everybody. So yes, as Pete said, I'm going to take you through equities. So just to sum up, what am I going to talk to you about now? As Pete showed you on one of the initial slides, we're adopting a neutral stance on equities over the next year or so. It's certainly a more cautious view than we had at the beginning of the year, and I think that reflects, how strong the start to 2023 has been for equities, certainly against the run of play that most predictors had at the start of the year. We're looking for around a 7% dollar return from global equities and a 12% return from domestic equities over the next year or so, which is in itself, I think, quite an attractive return. But I think we acknowledge, A, the variability and potential outcomes versus other asset classes, and the fact that, as Nolan highlighted, the returns from fixed income in their own right are quite attractive. So, we've gone for a neutral view. So that's the initial point. And for those that perhaps feel after the strong start to the year that, you've missed the opportunity to have got in at attractive levels and it's all gone, the other thing I would highlight is that, that's definitely not the case. And another theme that I really want to highlight is that under the bonnet, the picture looks very different from what the overall index level picture looks like at the moment. So let's get into it. It seems as if certainly one of the themes that's come through in the discussions we've had so far is that issue of risk. Pete touched on it at length, and I see Nolan did as well. And if there's one thing that we saw in the first half of the year in the equity world is the ability of equities to climb a wall of worry. And there's no doubt that throughout my investment history, I cannot recall a single time when I really felt that, the all clear to get back into the water was obvious. At all times, there's a long list of issues that sit out there. I think we have to accept that as humans, we're instinctively hardwired to look at, the things that threaten us far more than the opportunity. And I suppose that we live in a world of 24-hour news, which brings all of this in the loudest possible fashion into our living rooms at all times. And all I can say is that, the first half of this year really reveals the importance of trying to remain objective about, risks. They're always present, but it doesn't mean necessarily that that's the only story. And again, what did the first half show us? No one was talking about artificial intelligence. And that was really the thing that in this first half of the year really captured the imagination of investors, and was probably the principal driver of investment performance. So yes, risks are there. We know about them, but don't underestimate the ability of companies and markets to adjust and progress and benefit from, the changing world we live in. And that will remain the case as always. Thinking long term, we're going to talk a little bit today about, our tactical view in the shorter term, but really the importance of being in markets for the long term and letting time take care of growth, I think, is a critical factor to keep in mind, and not to become completely overawed by, this very long list of risks that we face. Now, changing gears, looking at, first of all, global equities and where valuations stand. So the strong start that we saw in the first half of 2023 certainly leaves us from a global equities perspective in a position that doesn't obviously look that attractive. We've come from lower levels from a valuation perspective to a point now where global equities are trading on around 17 times forward earnings. And you can see from the chart here that that's not obviously that cheap relative to our recent history. With rates relatively high at the moment, the risks that are out there, it's very easy to paint a picture as to, a lack of attraction in equities at the moment. Potentially, we see a softer patch ahead as the impact of restrictive monetary policy really starts to come through. And we've seen in recent times with valuations where companies disappoint, they are punished severely. The likes of Richemont in the last week or so, slightly disappointing earnings, share under tremendous pressure. And that reveals, I guess, the sensitivity around, where valuations are at the moment, and obviously the performance of companies as they start to feel the impact of higher rates and potentially a slowing consumer globally. So certainly a time for, can I call it, vigilance? Certainly you've got to look hard at your portfolio to make sure that the companies that you're in are in the strongest possible position to weather what may come at us over the next 12 to 18 months. However, the important point is to understand what the picture looks like under the bonnet. I apologize for what looks like quite a complicated slide here, but the real message coming through from what we are showing is the degree to which the strong performance we've seen in equities over the last 6 months or so has been absolutely dominated by a really small group of shares. It's something in my investment memory I can't recall having seen to the extent it's happened in the last 6 months or so. And it's really been, as I mentioned earlier on, those companies that have captured the imagination of the investor community around artificial intelligence that have absolutely set the pace in terms of market performance. And if you look at the other, 490 odd shares in the S&P 500, if you had been invested exclusively in those, you would have had a very different experience in the first half of this year, up fairly pedestrian 3% or so. Incidentally, these group of shares that have set the pace this year were really the ones that suffered in extremes last year. And to some extent, you could probably regard the performance as a bounce back to a degree from what was a really punishing period for tech throughout 2022, a year that I think as investors, we would all be happy to put behind us. So this key message, bounce back of the underperformers of last year, AI really the issue that's driven market performance, and everything else has been fairly pedestrian. Now, when you look at what that means in terms of valuations, again, you get a very different picture depending on what you look at. And I think it's important to avoid what's becoming an increasingly lazy behavior among investors of just talking about the market. The market is many things. So if you look at those AI beneficiaries, and that's the dark blue line in the chart on the left-hand side there, you can see that valuations have pushed up very aggressively so far this year as they have performed so strongly. However, when you look at the rest of the market, the other 490 odd shares, which is the gray line there, you can see that actually valuations are not that far away from their long-term average. And, one of the things we would highlight is that as we look forward, it's important to look through to the underlying constituents of the market, and that's where we think a lot of the opportunity will lie. So potentially, while we might not see a particularly strong performance from overall equity indices over the next year or so, given what's happened, don't underestimate the potential for the rally we've seen so far in tech to broaden out, potentially in that smaller and mid-cap space, which has really been left to the side through this rally, the potential for that to provide some really interesting opportunities. The other thing, why do I stress so much the importance of understanding what's happening underneath the bonnet? It's really important to appreciate how concentrated the index performance has become. This chart is just showing you over time the weighting or the influence that the top 10 shares in the S&P 500 has. And you can see that that's risen over the last couple of years from around 20% to almost 30%. And when you think that at the moment, those top 10 shares all share such a sort of concentrated similarity in being quite highly rated, being largely technology orientated, you really do get the sense as to how really the tail is wagging the dog at the moment, and the importance of being prepared to look outside of these shares and appreciate that, going forward as this rally broadens out, you may well get some really interesting returns from shares that to date have been largely ignored. But as certainly we get through the possible slowdown, really are poised for a strong recovery, even if at the overall index level, maybe the infatuation with AI wanes in the very short term, and we don't see equity markets performing as strongly as some of the underlying constituents will. So key message, look under the bonnet. There's some really attractive opportunities out there, shares that have been hit hard through 2022, and haven't really recovered yet to the extent you may think based on what overall markets have done. The other important point, at the end of the day, markets are driven by earnings. And if you take out energy, which has been a source of quite a lot of volatility over the last couple of years, you can see that we've been through a 3-year period now where US earnings have broadly gone sideways. And if you assume that over the longer term, we see in the US earnings growing at a rate of around 8%, really we're starting to see pressure building for a rebound in earnings. Yes, in the very short term, we're feeling the impact of higher interest rates, potential soft patch coming in the next number of months. Whether that translates into the R word recession remains to be seen. I'm noting a lot of pundits now suggesting that it's going to be a softer landing, and they're backing off the recession concerns that was certainly pretty much a consensus view at the beginning of the year. But as we look into 2024 and beyond, certainly we're anticipating an improving pace of earnings growth, which is ultimately what drives market performance. So yes, think about those opportunities under the bonnet. Think about getting through the soft patch and ultimately a return to better earnings momentum after what's actually been a really disruptive period for companies in the last number of years. So that's something to look forward to as time progresses. Now, turning to South Africa, it's a very similar picture in a way. You've got the index picture, and then when you look under the bonnet, a very different set of drivers that it's important to understand. So, what I'm showing here is, if you look at the black line in both charts, it's A, the performance of the overall South African equity market on the left, and B, the rating of the South African market on the right. And then trying to disaggregate that into important drivers as we see it of the South African market. And we're looking particularly at the industrial sector here. So the brown line is the performance of the overall South African industrial sector. But now if you split that into rand hedges, which is the blue line, and the domestically orientated component of the market, you can see both in terms of performance and rating a very different picture. And you can see the degree to which domestic industrials have really underperformed, very depressed ratings. A lot of the stuff that Pete spoke to at the beginning of the presentation explains why we've seen this. And there's been a crowding into the more assured defensive rand hedges, the likes of Naspers Process, Bidcorp, Richemont, all being sources of quite strong performance over the last little while. And then resources, you can see, I think it's important to recognize that they've been an important influence in why our market looks optically quite lowly rated. But the question is, what does the outlook appear like for them going forward? And, certainly we would have some concerns given the state of the recovery in China, the potential soft patch. This doesn't feel like a particularly good environment for resources. So be careful of simply looking at what looks like quite a lowly rated South African market and assuming necessarily that translates into an attractive opportunity to get in. Really important to understand the specifics around the individual components of our market. So our 12% return, where does that come from? Now, when we look first of all at the mining component, I touched on that just now, really what we could see is quite a binary potential outcome. I suppose it's always the case with miners. The immediate picture right now doesn't look great. Certainly, the lack of stimulus in China, the disappointing recovery, the potential for that recovery when it comes to be more orientated towards services than construction, as well as potentially a softer patch in developed markets that certainly is influencing our caution towards miners right now, despite what optically look like quite low PE multiples. That, of course, could change dramatically if we see China change its stance. So it's something we're watching very closely, but at the moment we are happy to be underweight the miners. Rand hedges, you saw how well they've performed recently. Certainly we appreciate that they are probably the more safe place to be. However, we do acknowledge that their ratings are quite high at the moment. And we're watching very closely the opportunity that we think will come through in due course to shift and pivot more towards the domestically orientated industrials. And Pete touched on, the potential for some of the really negative stuff that is, I think, dominating investor psyche at the moment to start to dissipate as we progress towards the end of the year, particularly around things like load shedding. We haven't yet made the move in terms of that orientation, but we're certainly watching it closely. We think we are at the moment in the eye of the storm. We're going to see some weak earnings out of domestically orientated companies, and we're looking for an opportunity to get in. But as I say, we think it's a little bit early. Naspers Process, obviously a very important driver of our market given their weighting. We're not anticipating much further narrowing in the discount there, but we do think that Tencent's earnings momentum is starting to recover. We're through that onslaught and attack on platform companies in China. And we certainly think that that will be a source of quite strong, just underlying momentum behind that particular set of shares. And we certainly think it remains a share that you want decent exposure to. And then just finally on financials, yes, they appear attractively valued. We think earnings are solid. We certainly already, I think, been through much of the recovery out of COVID. So certainly we see modestly positive earnings out of financials, a good dividend underpin. But I think one has to accept, with the cost of capital where it is, the case for a significant re-rating of banks and insurers is probably unlikely. So it's going to be a sort of modest earnings growth and dividend-driven performance from here. But it remains an area that we see as, fairly dependable. And if we start to see interest rates rolling, that could potentially be a source of decent returns from South Africa. So I think, in summary, potentially returns ultimately driven more by a rotation back into very beaten up South African industrials, financials holding their own, and then Naspers Process being a driver of performance. I just wanted to give a shout out as well to the opportunities that have really begun to present themselves in the unloved and ignored small and mid-cap sector. And what we're showing here is just the relationship between our forecasted earnings growth for some of our favorite small and mid-cap shares and the sort of PE multiple that they're on. And you can see a great number of them sitting on, mid-single digit PEs, while they're set to produce very respectable earnings growth. It's been an area of big frustration, I think, for many investors, but don't underestimate that ultimately, performance is going to be driven by earnings growth coming through. And these companies have certainly weathered the challenges in South Africa well. A lot of them have increasingly diversified themselves offshore. And as I say, we would urge investors to remain patient with these opportunities. Some great little businesses here that are really doing well. And, as I say, certainly worth a look. And if certainly we don't see, the market rewarding them, don't underestimate the potential for, corporate action to make itself felt in this space. So just to sum up then, neutral on SA equities, I've explained why, but don't, keep focused on what's happening under the bonnet. Be aware of maintaining the ability to stay objective in equity markets. There's a wall of worry out there. It's always going to be there, but it's about being invested and, letting time take care of your investment returns. So don't allow what is a very troubling environment out there, if you watch news every day, to become completely overwhelming to you in terms of your investment decisions. Thank you. And I'll be back for questions at the end.
Great. Thank you very much, Mark. I think that sums up the outlook nicely. So that covers most of the big asset classes out there. There's obviously a lot more detail and a lot of stuff that's covered in our Navigator document, which, as I said to you, we can send to you, you can pick up on our website. We've got two more speakers. They're going to be about 10 minutes each, just some important topics that we wanted to cover. Next up, so we're going to have Haiden talking about trusts. I think the rules and regulations around them, the impact is quite pervasive. I think a lot of people have got exposure of some kind. And then Henry Biddlecombe is going to round off with a look about, or with a summary of alternative investments and hedge funds and the kind of logic behind investing in that asset class. So let's start off with Di. Di is in a business called RCI, which is 100% owned by Anchor. We brought her on board to work with us about 7 or 8 years ago, and she's been of great value in helping our clients set up trusts, run trusts, and manage high net worth investment futures. So Di, we'll hand over to you.
Morning, everybody. Thank you so much for joining us for this presentation on the grey listing and its effect on trusts. We do think that this has serious challenges for all of us, for anyone involved in trusts, no matter whether you're a settler, a trustee, protector, beneficiary, any moving part within a trust. Please pay attention. There is important information here on changes to legislation. So as I have said, this is actually a big deal. Please do not ignore it. If you have a trust, you are probably a trustee along with other family members, but also have an independent trustee. This applies as much to you as it does to the independent trustee. If you do not have a professional trustee / independent trustee who is keeping up with obligations and requirements, this presentation is particularly important. You do not want to fall foul of what is going on here. But first, how did we land up in this situation? Let's put it in context and start at the beginning with a bit of history. So it starts with FATF, very difficult word to abbreviate and pronounce. That stands for the Financial Action Task Force. And that is the group, the body, that sets the international financial standards for global money laundering and terrorist financing. It is the watchdog. It was founded in 1989 and has 39 member countries, including SA. It was one of the founding members. FATF grey listed SA in February 2023 due to its deficiencies in complying with the international standards. FATF provided SA with 38 recommendations, nearly all of which impact on trusts directly or indirectly. And here we have listed what the recommendations that materially affect our world are. It's transparency regarding, as I've mentioned, all those people involved in trusts, transparency regarding the beneficial owners of trusts, and the definition of beneficial owner has been widened. We'll go into that in more detail shortly. And it's looking at preventing abuse regarding trusts, which are NPOs or non-profit organizations. So the next cog in the wheel, we go from global to local, is the Financial Intelligence Center. The Financial Intelligence Center is an SA institution which is FATF's watchdog on the ground and responsible for combating money laundering, terrorist financing, and enforces compliance with the FIC Act. It now expects trustees to be able to identify those three very important points: money laundering, terrorist financing, and tax evasion. What FIC and FATF are particularly concerned about is cash held by trusts, cross-border transactions, lack of records in trusts, abuse of NPOs, lack of reporting on conventions. SA was given 18 months from November 2021 to become compliant and did not do so. And what follows are the consequences of that, i.e. our grey listing. New legislation was put in place in the General Laws Amendment Act 22 of 2022. It aims to align SA's regulatory framework with FATF. It came into effect on the 1st of April 2023. We have been given 6 months to comply. These changes, please note, affect the Trust Act and the Companies Act. This presentation is concentrating only on trusts, but if you are involved in companies and any loop structures, please make sure you understand the rules that apply to them. And it's important to note that we now face hefty fines and jail time if we do not adhere to the reporting obligations. So what are those sanctions that may happen if we don't, or that will happen if we don't comply. There's a direct sanction. Non-compliance with the new reporting obligations by a trustee is an offence. It's punishable by a fine of up to 10 million or imprisonment of up to 5 years. The Master of the High Court also has the authority to impose sanctions such as disapproving a person's appointment as a trustee. And the indirect sanction, which perhaps is just as important for us, is that non-compliant trustees and beneficiaries will be denied SARS tax clearance pins for their personal tax affairs and prevent them from sending their foreign investment allowances offshore, amongst other things. I'm sure none of us want that to happen. So how do we become compliant? There are new rules regarding the disclosure of beneficial ownership of assets, and a trustee must establish and record the beneficial owner of the trust. As I said, the definition has been widened. And who is a beneficial owner now? And these I've listed below. And it's anybody basically who's involved with a trust is considered a beneficial owner. It's a natural person who owns a trust property, a natural person who exercises effective control of the administration of the trust, the founder or settler or donor of the trust, the trustee of the trust, and all beneficiaries named in the trust deed. A much wider definition of beneficial owner. And what duties is it that the trustees now have to comply with? Trustees have to keep records and documents on file. I'm sure many of you who are trustees are doing that already. Just become more mandatory now. Keep records up to date. That would include taxes and all resolutions and minutes, etc. that's done as part of the administration of the trust. And this is the big one, which we have not had to do before. Lodge records electronically with the Master of the High Court. These records are to be lodged on each beneficial owner by the end of 30th September 2023. This deadline I have put there is unlikely to change because it's a deadline that's been put in place by FATF. It's not a South African deadline. We South Africans are used to deadlines being extended quite often. We don't think that's going to apply here, so please don't assume that it will. The Master is going to maintain a public electronic register of disqualified trustees for all to have a look at. We have to record details of transactions with accountable institutions. Accountable institutions are defined in the FIC Act in Schedule 1 and covers institutions such as banks, life insurance companies, financial service providers, and more recently, accountants. And SARS, not to be left out of this party, now requires a reporting of information about all distributions to beneficiaries from SA trusts. We've seen the tax returns that have to be completed, and it is a lot more onerous than it used to be. So what is our conclusion? It's important that all trustees, and I keep on stressing all trustees, so any family member, not just independent trustees, are aware of the challenges we are faced with as a consequence of the grey listing, and that we do meet our obligations. If you do have any issues related not only to trusts, but to any looping structures you may be involved in or companies, please do let us know, and we'll certainly see what we can do to help you. I have listed there myself and Andrew Lawson, who are very involved at Anchor Succession, looking after clients structuring, estate planning, and this particular topic as well. And I put there at the bottom a special reference and thank you to Michael Honeyball from Worksmans, who allowed me to use his content. Lastly, if you would rather contact us through Anchor, there are Anchor's the one email address and their website. And I'd just like to say thank you very much for being with me and listening to this. And I now hand back to Pete.
Henry is one of our analyst fund managers who's looking after some funds as well in a management capacity. And We've asked him to talk about alternative investments and particularly hedge funds, which form part of the alternative investment suite. But over to you, Henry. Give us your thoughts.
Thanks, Pete. Yeah, so Pete's asked me to spend some time with you this morning talking through the merits of including hedge funds in your portfolio, not just because we think that hedge funds will be one of the better performing asset classes over the next while, but also because we believe that hedge funds are one of the most underutilized investment solutions across so many of the client portfolios that we review over time, which we believe is a big missed opportunity, given the really positive impact that hedge funds can have on the risk-adjusted performance on just about anyone's portfolio throughout the duration of the economic cycle. And I really want to address what I think are two of the primary reasons for that underutilization. And the first is that historically, hedge funds have been somewhat difficult to access for individual investors, but a huge amount of effort over the last couple of years on the part of regulators and in fact the industry itself have addressed this problem. And today you can actually invest in our hedge funds with as little as R1,000. Our hedge funds are daily priced. Liquidity is possible in just a matter of days. Our funds are broadly available across most listed investment service providers. And importantly, we've created very credible multi-strategy solutions which take the complexity out of the process of choosing the right manager for you. And in fact, later, Pete is going to talk through a new solution that we've created, which I think is a very, very elegant single entry point solution into the alternative investment universe. But we'll touch on that a little bit later. I think the second main reason that we find that hedge funds are underutilized is the fact that hedge funds are still viewed as a little bit of a black box space. And there seems to be a general perception that hedge funds sit on the riskier end of the investment spectrum. And just to start, I think it comes back down to the first principles of investing. And when you sit down to construct your portfolio, or at least to review the construction of your portfolio, I think one of the first considerations we all have is that relationship between risk and return. And so many of us instinctively view that relationship as a linear one, where basically you can't improve the returns of your portfolio without introducing more risk into your portfolio. But this is in fact not the case. And there's a very important factual nuance to this relationship, which you must bear in mind when looking at things like hedge funds. And if we take decades of market data and we plot it on the risk and return spectrum, that relationship actually approximates the U-shaped curve that you currently see on your screen. And the significance of that is this. The curve suggests that it's actually possible to improve the returns of your portfolio while also reducing the variability of those returns. Or in other words, while reducing the level of risk that you're taking in your portfolio. But to examine why this is possible, what I want to do is to look at the three portfolios that sit at the three extremities on this chart, starting with portfolio A. Now you can see this produces the lowest return of all portfolios on the chart with a moderate level of risk. And typically these portfolios include around 50% in stocks and 50% in bonds. So very similar to what you might find in the average investor's portfolio. On the other end of the spectrum, you've got portfolio C, and this delivers the highest level of return, but with the highest level of risk. And these are typically portfolios which make use of a degree of leverage, so not optimal. And what the portfolio that I'm really concerned with, the portfolio that I'm really interested in is, of course, portfolio B, which generates the highest level of return per unit of risk. That is the optimal portfolio. It's the most risk-efficient portfolio, and that's what we're aiming for with our clients and with you. And these are typically portfolios that include an allocation of between 15 to 20% in hedge funds. Now, I will admit that this graph is somewhat of an oversimplification of the data, but the important overriding principle here is that using hedge funds, it's possible to improve the return profile of your portfolio while reducing the risk inherent in your portfolio. And that's really the important line of thinking that I want to introduce to our clients today, especially those clients who aren't yet making use of hedge funds. So with that said, let's look at why hedge funds are such risk-efficient investment vehicles? And to start, the fact is they have access to a much more diverse investment toolkit. They've got the ability to go short. In other words, they can make a profit when the market's going down or when stocks go down. They have the ability to hedge out explicit risks. So a good example in our market would be the ability to hedge out the 10% exposure inherent in Naspers to create a very clean investment in the remainder of their portfolio. And they also have the ability to use option structures to limit the downside risk of a position or to lock in the gains on another position. Also, very important in the context of our own equity market, the JSE, hedge funds are less dependent on market direction to generate absolute returns. And in fact, they tend to thrive in volatility. Volatility creates shorter-term market trends that hedge funds can capitalize on, that long-only mandates simply aren't equipped to capitalize on. Also, the consistent and absolute nature of the returns that hedge funds generate tend to benefit from the power of compounding over time. So hedge funds start to perform better over longer periods of time. And lastly, I think it's worth discussing how hedge fund managers are paid. Now, of course, hedge funds are typically more expensive than conventional long-only solutions, and often this is viewed in a dim light by advisors, but it is important to remember that these fee structures are largely performance dependent. A large component of what hedge fund managers earn is determined by their performance. And we believe this creates a really sharp focus on producing consistent and absolute returns. And in my view, it's certainly a net positive because net returns are what is important at the end of the day. But with all of this theory behind us, let's look at what I think is a great practical illustration of these three factors at play. And what this is a chart showing the cumulative US dollar performance of the JSE All Share Index going back 5 years. And you can see that over this period of time, the market is essentially flat despite all of the volatility. And in stark contrast, it shows the cumulative dollar return of our flagship AG Rainbow retail hedge fund, which has delivered a cumulative return of 42% in dollars over the same period. And I think this is an exceptional example of how an active hedge fund strategy can extract real, consistent alpha from an otherwise directionless and volatile equity market. Worth mentioning, the fund was nominated for Best SA Long Shorts Strategy for 2022 at the recent Hedge News Africa Awards. But of course, when choosing a hedge fund manager, it's very, very difficult to predict this sort of outperformance in the absence of a crystal ball. And for that reason, especially for investors who are approaching the hedge fund space for the first time, we advocate the use of a multi-strategy solution, simply because it mitigates that manager selection error. Why bet the house with one manager when you can invest across a spectrum of managers and achieve a good middle of the road outcome? As multi-managers, we also take care of the correlation analysis for you. So in other words, it makes no sense to invest across several managers who will all perform in the same way at the same time. You don't achieve the benefits of diversification that way. We ensure that we invest across managers who complement one another to optimize your risk-adjusted outcome. Also, in a multi-strategy fund, we are able to rebalance the portfolio consistently in a very tax-efficient manner. So we don't create tax events for your clients every time we rebalance. And all of these factors play into what I believe is a consistent, superior risk-adjusted outcome when compared to a single manager strategy. And a great example of how this works is our own multi-strategy fund, our AG Fusion fund, which is now essentially 3 years old. And it's delivered a respectable cumulative performance in rands of 57% since inception in December 2020. And that certainly compares favorably with the market's performance over the same period. But a more important takeaway for me is how the multi-strategy fund is performed relative to the constituent strategies. And this is something I want you to take note of. Have a look at the huge cumulative performance difference between the best performing and worst performing underlying strategy in the fund. That is illustrative of the type of risk you take when selecting an individual, a strategy that's managed by a single individual. And with a multi-strategy approach, like as in with the Fusion Fund, you achieve a good middle of the road outcome. So I think this chart is a great endorsement of the efficacy of a multi-strategy approach to hedge fund investing. The last point I want to make is also around how hedge funds tend to benefit from the consistent and absolute nature of the returns that they generate over longer periods of time. And that's due to the phenomenon of compounding, which we're all familiar with. And I've used the performance of a cross-section of our own hedge fund range here to illustrate the point. And you can see that as we measure the performance of those funds over a longer time period, 1 year progressing to 3, progressing to 5, you can see that hedge funds really start to shine over a longer period of time. With particular mention to our Rainbow Fund, which has achieved roughly double the performance of the market over a 5-year period, and one of our longest standing multi-strategy solutions, our AG Select Fund, which has also achieved some nice alpha there over the same period. So I guess the takeaway from this slide is, if you're going to invest with hedge funds, stay invested with hedge funds over a long period of time to really experience the benefits. So if this conversation today has struck a chord with you, please do talk to us. We have a broad spectrum of hedge funds available, ranging from conservative to aggressive. We've got SA, European and American-centric strategies, and some very competitive and effective multi-strategy solutions. The right hedge fund for you depends very much on what the rest of your portfolio looks like, and that's something that our wealth managers can certainly help you with. Our funds are also available across most listed investment service providers. And something to think about is that I think hedge funds are becoming more and more applicable in living annuities because the consistent and absolute nature of the returns is very well suited to a product where you also have regular redemptions or withdrawals. And also bear in mind that Regulation 28 compliant portfolios can participate in hedge funds up to 10% across the product category, up to 5% in a single hedge fund of funds, and up to 2.5% per individual hedge fund strategy. But what I'm going to do now is I'm going to hand over to Pete. Like I mentioned before, Anchor's been busy with the creation of what I think is a really, really elegant single entry point solution for investors into the alternative investment universe.
Thanks, Henry. Yeah, I think over the course of the last 5 years, we've been spending a lot of time and effort on the alternative part of the market. And that's really just non-vanilla equities and something as an alternative to non-vanilla equities and fixed income. Interest rates are a lot higher now, so there's some very interesting equations out there. Over the course of the last 2 years, we've spent quite a lot of time developing this particular fund, a fund of alternatives in the local space. And we launched it about 6 months ago. We haven't made a big noise about it because obviously we want to establish some sort of track record. But this really bundles together in one fund a number of our alternatives, similar in some respects to the AG Fusion fund that Henry was talking about. But in addition to hedge funds, we often come across some special opportunities in our space. Where we, for example, last year we helped Alviva delist and made a nice return for clients. Some specific property opportunities, which are usually in the global space, where you can get nice compound dollar returns. And often these opportunities are quite small in size or are not practical to be accessed by all of our clients. So we've created one fund where clients can buy in on a unitized basis into a fund, which gives a broad range of the non-vanilla equity and income opportunities that we find as the Anchor Group. And we're pretty confident that this can materialize into kind of a double-digit 10 to 15% annual rand return. And every now and then, when one of the special opportunities come off, or the private equity type opportunities that we've been able to invest in, if they come off nicely, you can have a time period with a higher return than that. So, if you're on our client base and you're one of our IFAs or private clients, we'll communicate with you more on that spectrum. So thanks, Henry. We finished with that slide. I think I guess the takeaway is that we're very active in trying to find opportunities for clients. I think we've learned over the course of the last, or been reminded rather, over the course of the last 24 months, that the volatility that does come with equity markets is quite unnerving for some people. I think a lot of sophisticated clients are happy to see through that, but there's certainly space for 10 to 30% in a portfolio with a nice regular compounding 10 to 15% in rands, or 8 to 12% in dollars. And we've been putting a lot of effort into creating those in an easily digestible format for our client base. So, feel free to ask the wealth managers more about that. So we're going to run for another 10 to 15 minutes. That is the end of the presentations. We're going to go through a Q&A session. There's lots of interesting questions out there. There's about 750 odd people who've been attending this webinar. We will be sending out recordings of the presentations. There was an issue with the Wi-Fi connection in Dai's presentation. I've subsequently received quite a few requests for that. So we will re-record that without the Wi-Fi issues and send that out in the communications, because the trust world and the way it's changing is obviously of huge relevance to our clients. So maybe if I can just ask the panelists to put their cameras back on and pose a few questions to people. I think maybe to Nolan, a question: what are your thoughts around the hype around the end of the dollar? I think you see a lot of headlines around that, particularly in the BRICS context. And then what do you make of, are we talking about currencies? What do you make of Goldman's call of 14 Rand to the dollar by 2026? Goldman's, in my experience, like to, or is at the extreme of things and like to create some headline grabbing type forecasts. But perhaps give us some color on those two, Nolan.
Sure, thanks, Peter. So the end of the dollar, yes, we actually published an article on that, I think about 3-4 months ago. So you will actually find that on our website as well. But the long and the short of it is, it's a little bit premature to call for the end of the dollar. The dollar is really the currency in which most international trade is priced. Certainly there is a drift away from it, but it's unlikely to gather enough momentum, enough steam to completely derail the dollar for the foreseeable future. I think the challenge with the BRICS currency, to be quite blunt, is trustworthiness of currency is quite important. And it's a little bit, people have concerns about the Rand, people have concerns about the Russian ruble. We can chat about the Chinese currency, but the opaqueness of those currencies makes it difficult to continuously price in those currencies. And as a result, people still revert to the dollar. So gradual decline, certainly, for the foreseeable future, I think the dollar is going to be the world's go-to currency. So yes, Goldman Sachs put out a sort of forecast on the Rand, talking about the Rand at 14 to the dollar in 2026. And my immediate reaction when I saw that was, ooh, an analyst forgot to update their model, because it is very extreme. Goldman's, as Pete says, is not known for sitting on the fence. They take a view and they make it very, very apparent what their view is. Fair value of the Rand, I was saying, is like 15-ish at the moment. It's probably by 2026, the Rand appreciates 4% per annum. We're talking about a fair value of the Rand like 1650 or something. I haven't done the math. So for the Rand to actually be at 14, I'm going to need to stretch my modeling assumptions quite significantly. And I think it's very improbable that you're actually going to end up there. Do we see a stronger Rand? Could the Rand pull back to its fair value? Could it trade below fair value? Yes. Could it trade below 15? It would take an amazing alignment of planets that we just don't think is reasonable. So we're kind of looking at that with a bit of skepticism.
Okay, thank you, Nolan. Mark, a question on the SA banks, which are, got very nice dividend yields and still appear to be growing quite nicely in spite of very tough economic conditions. There's a specific question talking about, the banks talking about the estimate of R1 trillion for solar financing or renewables financing. How material is that in the lives of our SA banks? And over what time period could you see all or some of that flow through?
Yeah, Pete, it's a great point, and I think one needs to see it in context of it's one positive factor amidst many drivers. So, it really has been a source of great new credit demand after a period when I think the banks were really struggling, particularly in the commercial corporate space, to find sources of new credit growth. So yeah, I definitely think it's a reassuring component of the income statement, if I can call it that. But you need to see it in context of all the other drivers, what's happening with net interest margins. Obviously, at the moment, we're at a point where bad debts are starting to bite a little bit. So credit losses are ticking up, and that's a bit of an offset. So it's a source of positive momentum, if I can call it that, which gives us the confidence that banks, and I think this is a point I made, that I think banks are a relatively secure source of some earnings growth. I don't think it's going to be spectacular. We've already had a big earnings rebound out of COVID, but we see them as a relative place of safety, and a portion of that really does relate to the asset growth opportunity that comes from solar, undoubtedly. And it's certainly a multi-year theme that's playing out. I think that's the other point. It's not a one-year event. I don't know if that answers it adequately. I think good, but don't lose perspective on the other important drivers of what ultimately gets you to the bottom line of a bank.
Mark, while we've got you and we're talking about the SA market, how do you see commodities and commodity shares playing out over the course of the next 6 to 12 months in the context of, being fairly unclear as to whether China stimulates further or not?
Yeah, so again, I think just to reiterate the point I made, if it didn't come across clearly, based on what we can see today, we're pretty cautious on mining shares over the next 6 to 12 months. Yes, we can talk about longer term themes around green transitions and all of that kind of thing, which undoubtedly create longer term structural growth opportunities for certain commodities. But in the immediate short term, we're pretty cautious about the outlook for mining shares and commodities. If we were to mark to market earnings based on spot commodity prices today, pretty much all of the miners, you're looking at quite meaningful earnings downgrades. And that's an environment which is generally not that supportive for share price performance. I say that's the picture as we see it today. It's absolutely something that could change sharply if we were to see a major stimulus package announced by the Chinese, for example, at the weekend. And that's, I suppose, the nature of the beast. That's the sort of thing we look for. So purely on the basis of the picture as it's presented today, not great for commodities in the next 6 months or so, or mining shares.
Let's switch over to Da. Da, if you can unmute yourself. And if somebody's got a trust operating at the moment without a professional trustee, just to be clear, what exactly should they be doing?
I think the best thing these situations. Can you hear me? I believe my sound's awful. Can you hear me?
Yeah, let's give it one more bash. Carry on.
Okay, so the best thing, and maybe read my lips, email me and I will tell you.
Okay, thanks, Da. Henry, maybe over to you. Just a few questions which are, the often asked ones about hedge funds. What environments do hedge funds favor? I think some people still have memories of 1988. I'm not sure if you were born then, Henry. When hedge funds, I can give you a little bit more experience. Some hedge funds lost a lot of money. How do we protect ourselves from that? Because obviously what you don't want to be in is any type of investment which can suffer significant loss. So, what type of environments, how are they protected from the big losses? And then just a bit of an explanation about performance fees and high watermarks. How do fees actually accrue through to a fund manager? I think, in my experience, people just want to see that there's an equitable, that, most people are happy to say, you make me a lot of money, you can share a bit in it. But people want some kind of assurance that people are never sharing in something that shouldn't appropriately share in because of a wonky equation. And maybe just to talk through that a bit.
Yeah, I think so. So, maybe one of the complexities around investing in hedge funds is that it's such a broad-ranging term. And basically, any kind of fund that makes use of leverage and derivatives can be termed a hedge fund. So it's important to understand the nature of the hedge fund that you're investing into. And, certainly the hedge funds that we manage within the Anchor Group prioritize capital preservation over all else. And that's the role that we believe that they should play in a client's portfolio. And we can talk you through some of the metrics that you should be looking at. But just to touch on a few of the most important ones at a high level, you should be looking at the level of gross and net exposure that they employ when investing into the market. And you'll note that most of our hedge funds have a lot less absolute net exposure than the market itself. They kind of typically range between 40 and 60% at a net level. So these are conservative funds, again, which prioritize capital preservation. There are riskier products available, but those are only appropriate in certain instances. So like I said in my presentation, the most appropriate fund for you really depends on your appetite for risk, your ability to take on risk, and what the rest of your portfolio looks like. Moving on to Pete's point on fees, I think really the purpose of a high watermark is to ensure that a manager isn't paid for the same performance twice. So in other words, if the value of your investment in a hedge fund falls below the maximum value that it reaches in the past, you're not going to pay for performance fees when the manager gets your capital back up to the previous level. I mean, that's really the long and the short of it.
Okay, cool. Then if I'm going to pick up one or two and then head back to Nolan. There's a question, why is Trump's return a worry? I don't think we're necessarily saying by definition of it is, but I think my reference was to a particular individual's lack of appetite to live in a Trump-driven economy. I think when we look back with the benefit of hindsight, a lot of the moves and statements that Trump made from an economic point of view had a lot of positives. I think a lot of people have a lot of personal issues with Trump, but it's, certainly from our, we look at the things factually from an economic perspective. But it certainly does result in a very different set of circumstances from an economic point of view. If Trump comes back into, the Republicans come back into power. I think one of the issues is the divisive nature of politics nowadays, and it's kind of all black and white, all or nothing. There's also a question on UK property. So I was actually in the UK last week and spent quite a bit of time with guys who operate in the UK property space there. And I think one has to clearly differentiate between, the on-the-ground property and property shares, because shares obviously have some holdings there, but often price in a lot of the future. From an underlying perspective, I think the US economy is the UK economy is under quite a bit of pressure. You have got, historically, and the property market's an interesting one, because historically, particularly in office, you've had these long rental agreements, often with very small increases. So, 0 to 1 to 2%. And the same rents over a 5-year period. Then you get to the end of the lease, and, where the properties are popular, and good UK London property will always retain its value. You're seeing 15, 20% rises. But in the lower grade, much like South Africa, you're seeing some quite big dips. And what you typically see in a property cycle, so with interest rates having gone up quite dramatically there, is property transactions dry up. So people can't, the affordability, if people do their models, they simply can't pay what they would have paid previously for the same property because of the cost of money. So the buyers start to reduce what they're prepared to pay, and sellers walk away and step back because they say, hold on, I'm not transacting at that value. And then the reality of high interest rate comes in, where highly geared properties come under immense pressure. And it's really that segment of it, where the banks are saying you have to reduce your gearing or sell your property. So you start to see some quite sharp decreases in property values. So there isn't really one pervasive view on UK property. very different dynamics for retail. In the office space, high quality and lower quality have very different outlooks. And residential actually looks to be holding up surprisingly well, largely because of a lack of new stock. But one can see elements of that coming under some pressure over the next while. So I think and then in terms of UK listed property companies, all trading at big discounts to net asset value when they're in problematic sectors. So I think the property is a skill set and expertise and an asset class all by itself. In our stockbroking business, we've got quite a few analysts full-time on property. So Billy, who asked the question, feel free to communicate with us. The answer to the view on UK property is, very much depends on where and what, and very different prospects across the board. But as a generalization, the impact of much higher interest rates probably still hasn't come through completely. Then Nolan, just to talk about yield compression, looked at very simply, something like a bond. So bonds, you're getting your kind of close to 1% a month coming through. And then whether you get a 12%, if yields stay the same, you get a 12% return over a year. I'm exaggerating a little, sitting probably at 10.5, 11. And then if yields, depending on yields, whether yields go up or down, that determines whether your return is above the 12 or below the 12. With elections looming next year and other geopolitical factors, how do you factor that in and how do you view that? And then we're seeing some compression between Namibian and South African yields, which is quite an interesting one. So maybe just give us a bit of perspective on that.
All right, so let's look at South African yields first. And if we look at what drives our yield curve, 60-70% of it is really we follow global interest rates. So, we've sort of hitched to US yields, and as US yields have been going up, so our yields have gone up. And when US yields plateau, which is our perspective for by year end, we think our yields plateau. And next year, I think the gradual drift downwards starts for both the US, and then we follow suit. So looking at it, 60-70% of the contributors to our yield are actually saying we're probably going to turn positive. We think that yields are lower in a year's time. We've then got the idiosyncratic factors, as you say, the election coming up, load shedding, etc. And how does that all factor into it? Those have been pretty negative over the last 3 months if we look at what's really happened here in South Africa. And we think that a lot of those negative factors probably resolve themselves. We probably have a better outcome than expected. So again, there's a lot of negativity priced in, and as that negativity dissipates, I think the balance of probability is that yields are a bit lower, and that basically means capital gains for bonds. So what's the difference? Why have South African bonds been weaker than Namibian bonds, which is really what you're asking? And the long and the short of it is Namibia doesn't have load shedding. So those idiosyncratic factors have been a lot more positive in Namibia. They've got a growth rate of about 2%. They've got a big oil find that they haven't actually decided to economically sort of chase yet or develop. But you've kind of got a world where the news flow has just been a bit better, and that means that they haven't had those sort of country-specific factors weighing them down like we have in the last 3 months. As a result, it totally makes sense that Namibian bonds have outperformed us. Looking forward, though, it's clear that Namibia's got a budget deficit problem, and that's going to result in increased bond issuance. Also, they're not tapping international bonds anymore. It's going to be domestic bonds. Consequence is we think that actually Namibian bonds start to weaken a bit and the yield curve steepens. So it kind of works itself out in due course. And as a
Okay, thanks, Nolan. Cool. I'm going to answer one final question and then we'll wrap it up. We've gone a little bit over our time period. So we talked about our fund of alternatives. We're capturing, and there's kind of 2 offerings in our space. The anchor one is capturing some special opportunities. There's a question as to what that is. I think the core of what we do is equities, bonds, property, etc. On top of that, we've got different ways to capture that through hedge funds and the like. But ultimately, out there in the marketplace, there's always specific offerings and risk return profiles or deals that one can do that you might be able to, you'd be very interested in participating in your own name. That's largely been outside of our investment universe over the course of the first 7 or 8 years of our business. However, we have come across quite a few unique opportunities, but the issue being only 10 to 20 private clients can really kind of participate in them because it's very difficult to unitize and make broader. So this fund, we're going to put 10 to 30% of it in those kind of opportunities. And what could they be? So the ones we've done in the past have involved some delistings. And I think one of the very interesting opportunities, as Mike alluded to, is crazy low valuations on some small and mid-cap shares, where if you're in the right ones at the right time and you capture the buyout, there's been 50 to 100% returns achieved there. Some specific private equity opportunities. So the fund's got a stake in a lot of high net worth families out there, have participated in Richard Came from Data's initiative for fiber in the US. They've been very successful in South Africa and the UK, and a very interesting equation with a very high potential return. Some mezzanine financing. Often there's people or businesses that need money for a short time period, and banks, the complexity of what's offered by banks isn't attractive. Some property opportunities. I think, we talk about the UK earlier on. We think that over the course of the next 6 to 12 months, there'll be some really good properties that get sold cheaply in the UK to take advantage of that. And some private deals. So I think just giving you a feel for obviously our network of 15,000 clients and strong shareholder base, we come across some really nice opportunities which in the past we weren't able to share across a broader spectrum of investors. And this gives us the opportunity to do so, enable somebody to buy into a fund. But it's certainly just a component of what we're doing there. The underlying is equity markets, hedge funds, and just trying to, the whole objective is to try and achieve that compound, sustained, low volatility, 10 to 15% per annum, which when equity markets are in trouble, people find particularly attractive. But also, as you said, higher interest rates make that a little bit easier. So, folks, that's what we had to say today. Thank you very much to all of you who joined and have posed questions. Feel free to contact your IFA who deals with us or your wealth manager at Anchor. We really value your time, and we hope that you find it fruitful.